The Hedgeless Horseman here. It's September 15th, 2022. This will be your daily dose of optimism and common sense, hopefully. Uh, let's begin with the fact that, as you are well aware of, the sentiment in the mining space, especially gold, silver, junior space, is absolutely atrocious. I don't remember last time I saw it this bad. I mean, barely anyone saying anything positive on Twitter even lately. And most companies or many companies are making new 52-week lows. And again, 90+% of people don't see a reason for being positive or buying juniors, especially gold juniors, which I think are actually cheaper than silver juniors on average. Why? I mean, it's pretty simple. It's the fallacy of how we work as humans. We look at the past and then project that to the future, and why many are selling here and will sell if they go even lower is because they fear tomorrow. Uh, they fear the pain. They are front running the pain if this continues. I would say that pain is, the duration of a downtrend and then times the let's say the degree of the downtrend. Like, 90%. If a stock would go down 90% in a day, that would suck obviously big time. But if that was over in, a day, that 2 days later you were back to even, that would be a very short term pain. But stocks or a sector or whatever that goes down 90% over, let's say, 4 years, that's way more pain. Obviously, it's like you're quote suffering for a much longer period of time. Uh, and yeah, again, I think, I mean, most people, I have not seen, I think, I don't know if I've seen one comment on juniors, especially gold and silver juniors, where someone is selling because they say they think they bought high, or they think that this is too high of a price for said junior, that they are overpaying for the assets that the company has. I don't think I've seen that once in quite some time. And the rationale for selling, or I mean, most of the people who are, I mean, there's quite a few now that have actually sold out of the gold junior space. They can't take it anymore. It's been going down for more than 2 years. That's enough. I mean, they take that as proof that you can't make money in this sector, because you have seen on average a 50% paper loss in most juniors over the past 2 years. So that's proof enough for them that this sector simply does not work. You're not making any money in this sector. So they're leaving to go for harder sectors, let's say uranium, lithium, and all of that, because in those scenarios, the last 2 years have probably been positive. They might be up, especially in the recent past. So they're projecting it going higher. And if you watch most of the uranium investors, let's say, or your typical uranium investor, there's always the promise of tomorrow, a carrot being dangled that this is going to happen and that's going to happen, which will make uranium shoot through the roof. And it's coming, and they have the recent past as evidence of this being on the way, basically. So you can see that's simply the flip side of it. I'm not sure that uranium juniors, for example, are that cheap. I think they are buying them because they think that uranium will continue higher, and that some other person will come along and pay more for their shares tomorrow. So it's basically all a momentum trade, and that's how most people work. That's literally how it works, and we justify our actions, of course, any way we want to. But it's like when people try to sell me typically on uranium, it's again the the promise of higher prices in uranium, and that will, the uranium companies that have already gone up, they will go to the moon. That's very possible, etc. But it's like if you're actually a rational value investor, you don't want to pay up for something that really has not happened or has no guarantee of happening. At least too much. I mean, I'm into exploration stocks, obviously in gold and silver, so I'm also projecting something about the future. But I'm projecting internal value creation by the company foremost. And I see a rising gold and silver price, A, as inevitable actually for starters, but B, as a bonus. So if I can find a company that increases its value, that should be good enough. And then if we go into a gold and silver bull for real, that's just going to be the icing on the cake. And, who knows, maybe, 2-3 times the return I would get if relative to if gold and silver stayed flat and the companies actually kept on performing anyway. But that's I mean, there's some logic to that. Again, it's like value investing. What are you paying for it now, and what do you think it is worth now? Momentum trading, etc., or pure beta investing is obviously, yes, that's a bet on a better sentiment, because again, I don't see many people talking about uranium juniors or uranium companies without the main argument to buy them is that the uranium price is going to shoot to go to the moon. So the question is, okay, what happens if that does not happen? Did you overpay for a future that has not happened yet and is not gonna happen in the short term? I don't know. That's like, I don't know much about uranium, so I try to stay away from that, because obviously, I mean, it's hard not to get attracted to it, because again, prices have been going up lately, etc. But if I actually take a step back and think about it, why am I buying into this? I haven't done proper due diligence on how the uranium market works, or supply and demand, or anything like that, and how am I going to go about valuing the companies themselves? That's going to require even more time. So if I would be honest with myself, I would simply be buying uranium because I thought that somebody else tomorrow is going to pay more for my shares than I paid for them today. That leaves me very uncomfortable, because in that case it's pretty obvious that I am a FOMO investor, that I'm simply one of the sheep that just tries to come along for the ride without actually knowing really what the case is. I don't even know if what I'm buying is really that undervalued. So I try to stay away from that. I mean, I own I own a bit of a Kraken Energy. That's about it. It's an extremely small position, simply because I'm not comfortable with that. In the gold and silver space, I understand the companies much better. I understand the market much better, and it's beyond obvious that they are actually undervalued and cheap. That's like, I mean, you have the perfect layup, but if I were to sell them, for example, I'm selling something that is generationally cheap in that case, or blatantly cheap. So it's not, I'm selling something that would be a mistake to sell by definition. To buy something that I don't even know if it's cheap or not, should go higher or lower or not, and simply betting on something that is perhaps overvalued to become even more overvalued. Or in the case that, let's say, uranium shoots through the roof and my uranium juniors go up. How is that a good long-term strategy? I might be up, let's say, if I see through that, let's say I'm up 200%. What strategy did I actually use? I was just one of the fools in a greater fool scenario. Yes, there were greater fools that bought even higher than me, but it's like when you really think about it, I would feel like it's pure FOMO in my case. I couldn't really write a case why am I buying this and that, except for the very simple fact that I simply thought it would go higher. And again, the opposite is what we're seeing in the gold and silver space right now. Everybody fears tomorrow. We fear the pain that has not happened yet. We fear that if I don't sell today, given the trend, it's going to go down tomorrow and I'm going to feel worse. We fear the pain of the near term, of tomorrow. But when you think about it logically, rationally, some common sense, like if they're generationally cheap, that means it's a generationally high likelihood of them going way higher sometime in the future. So it's all about time perspective, really, from that case. And now, for example, lately everybody's focused on the dollar. I see talk about the dollar. I'm not touching gold and silver. The dollar is, has been going up. Obviously, it has been going up and it's ramping. So again, everybody's like, yeah, I want to. Most people, they believe this will. I mean, if the dollar goes here or here or whatever, they're gonna fear that it's gonna go higher. So they're never gonna feel comfortable buying unless the dollar is, let's say, went from here to down here. Then they probably, it's like, yeah, that looks to be a top. But otherwise, there were a lot of falls, like breakdowns or whatever. So it's almost impossible to really know, which makes it kinda, in my opinion, noise. If I can't possibly know it, why would I use as a due diligence? Why am I not being honest with myself and saying, hey, I have no idea how this is gonna play out. I have no idea when it's gonna top. So to use that as a due diligence, that I'm gonna use that as a timing tool, makes no sense to me. But a lot of people think that right now. I'm waiting for the dollar to put in a top, and then I'm gonna go buy gold and silver. And disregarding the fact where they are valued at right now. So it's like, this is the, okay, first of all, okay, let's overlay gold futures with this dollar. Again, the idea of, we fear the short term, that we're going to be down tomorrow, because that obviously closes, and that pain would be worse if we knew that we were going to drop 20% in our portfolio in 2 years. That wouldn't hurt us much today psychologically, but the fear of that happening soon is much more prevalent. And you have, given the past performance of the last 2 years, we have an infinite amount of negative experiences that back up that, and reminds us of how painful that is. But if you look again, it's like, yes, this was the dollar ramping way higher, obviously. Okay, what happened actually when it topped? Gold went on the biggest bull run in quite some time. So it's like, that's what comes after at some point, because now people are like, I mean, if you disregard how cheap the juniors are right now, and you're basically, I'm never gonna buy them here unless I see a top in the dollar, for example. That makes absolutely no sense. Because first of all, you don't know when the top is in. And if you know they're so cheap that the only way to go materially is higher, then the risk reward is so immensely skewed in your favor anyway. And again, it's like, I don't know if we're here. I mean, yes, we're touching this line. I don't know if we're here. If we're here, then I mean, if you went back in time and you didn't buy here because you saw this ramp, and I'm gonna wait for the dollar, I'm gonna play in other sectors or whatever, and then let's say, okay, now you're starting to get convinced that the dollar has topped. Maybe, I don't know how much, let's see what, I don't know if I can actually measure that, but anyway, let's say juniors were up like 100-200% just from this bottom here already. So you missed out on that because you were waiting for the top. So it's basically, one could say it's like, let's say this is price of gold, obviously, but let's say that, juniors are basically infinitely cheap. So you're still fearing like this movement down here, up here, because you can't have proof. You don't have proof that the dollar has, quote, topped. So you're not buying because you fear that this would continue more. When you're convinced that the dollar is like, yeah, now it's probably topped, then maybe again you might have missed out on a 200% return from here, let's say. I'm just guessing here. Who knows? Maybe it's 50%. 50% is still a lot, and 100% is an extreme amount anyway. So I mean, since it is inevitable, unless the sector goes away completely, and we know that there's one thing that's for sure, that's that sentiment always changes. So if you're already at abysmal valuations, and you fear that abysmal valuations can get cheaper, and that's why you're holding off buying, that makes no sense from a risk-reward perspective. Because let's say this was the actual, risk to the downside, and we pretend these are junior minor valuations. This was the upside you were measuring that against. So you're not prepared because you can't stand this going down 20% more, whatever. Even though we were at record low valuations, and what happened after record low valuations was like a record-setting rally. Can you see the risk reward here? Again, I don't think it makes any sense at all. And yes, we're looking at gold here. It's like, yeah, it could break down or whatever. Let's compare just Bear Creek Mining in purple, which is my junior sector sentiment proxy. Okay, this is from the top in 2011, the epic top. I mean, again, from here, let's say, Bear Creek Mining went up from here, let's say, this was the flash crash, and gold was actually a lot higher than here. But if we took from Bear Creek Mining's levels here, that's like 5,000%, I think, something like that. So imagine like and as well here, I think this was 3,000 or 2,000 or something. I mean, imagine the risk reward. Let's say you sold down here because you feared it could go down 20%. And who knows when you bought back? Maybe here. I mean, this alone is probably 600, 700, 800% that you missed out on until you were comfortable paying more for something. I mean, you could see the gold price, sure, it went down, but it's like if you look at Bear Creek, I mean, gold is back to this level. And back here, gold was, Bear Creek was up here and went down here. I have a hard time believing that so much changed fundamentally for the value. No, this was like sentiment, this was a liquidity washout. So it's like this sector makes absolutely no sense a lot of the times. That's just how it is. And like you see now, I mean, if this is again Bear Creek Mining, this level here is lower than the flash crash. I think we've reached, on par with the biggest bear market bottom in, decades. Gold has done this since 2018. Bear Creek has done this. So it's like people are fearing the dollar and fearing washout in gold, but and that's why they don't buy gold and silver juniors. But I mean, come on. I mean, they're already pricing in that. That's what Rick Rule meant when he said that it's the cheapest he's seen the gold miners in the last 49 years relative to gold. So it's like we're paying for something that's pricing in a gold price down here already. Yeah. Let's say the juniors are pricing in a gold price of like, well, let's say 1,500. I mean, the risk reward is absolutely insane. I mean, what if the dollar topped here? I'm not saying it's gonna, but it's like, how big of a layup can you ask for? You're underpaying for the current scenario, and you're paying something that has not even happened yet. Most gold miners today, especially the larger ones, they're still making money. And we're priced like it was 2015-16 with gold price of $1,100 and everybody was operating at a loss. Then these valuations would make sense. This makes no sense at all today. So in the case of, if we relate that to uranium, I suspect that uranium miners might be up here, let's say, in valuations. And pricing in, if this was the uranium price, they're pricing in a uranium price that's here already. So you're overpaying, you're paying a premium for a bullish future that has not yet happened yet. And I think that has been the case in silver juniors for quite some time, but now they're actually becoming really cheap. Which, I mean, says something, I think, about this sentiment, because silver juniors typically traded at a premium, regardless of how bad the market was. And this again, Bear Creek Mining, yeah, so it's pretty much down to the worst bear market lows here. Obviously, things have changed for the company. I mean, I think it has a higher valuation now than here because they've diluted, but they've also added assets, etc. For that dilution, I think so at least. But regardless, I mean, you can see that again. It's like, where are the risks? Are they to the upside or to the downside? We have these flush outs, like, okay, down almost 80% from here to here. That's like well, that's even more. That's like 4 years. I mean, depending on if you count this as the bottom, this was like 2 years and then 2 years more. So it's like a big washout every 2 years lately. And this has gone on for 2020, yeah, 2 years as well. And you can see, which I've said before, it's like, look how quickly the rallies come. I mean, down here, nobody was buying juniors. Absolutely nobody was interested in buying juniors. Regardless if someone traded at an enterprise value of 0. So basically, theoretically, impossible to be overpaying, because the assets were valued at 0. And as we know, I mean, again, this, you have to remember this at all times, especially now. Sentiment always changes. There has not been a market where sentiment has never changed. And that's, I keep hearing that stuff. It's like, if sentiment gets better. They literally believe that, I don't know where they get this from, but it's like, they literally tell themselves that I shouldn't buy because I don't know if sentiment is going to change. How crazy is that? That has never happened. That has never happened. Gold has been around for 5,000 years. And mining has been as long as gold has been around, because we obviously mine to get the gold. So if they're saying that this sector is going to go down forever, and that's, it might, this time might be different. This time the mining sector will go away, which has never happened in 5,000 years history. Well, yeah, pretty much. So it makes absolutely no sense. But that's, again, how you justify your emotional, I mean, that's what we typically do as humans. We do what feels good, feels best, then we justify it in hindsight, trying to make sense of it. While in reality, it makes absolutely no sense why you should be selling down here. It makes absolutely no sense why you should fear tomorrow. Because tomorrow, we're after the best long-term results, right? So who cares if it goes down 50% tomorrow and 800% up a year from now? Unless you expect to die tomorrow, or that you're gonna be done with this investing thing here. I think it's better to think about, hey, where are these gonna trade in like 3 years? Probably way higher. That's all you need to know. And again, risk reward. If we're down here right now, I mean, they're already unsustainably cheap. But again, it's like, if our biggest problem is that they can get even cheaper for a period of time, that's not really a problem. A problem is that you bought something that is overvalued and should go down and stay down, and you're never getting a profit of that in that, no matter how long you stay in it. That's a permanent loss. Otherwise, it's just degrees of how much. For example, I'm gonna use this. I saw in the tectonic chat. This is just an example because I saw somebody post about it in the channel. Somebody asked like, okay, can some pro tell us, okay, when is the bottom in? What should we look for a bottom to be in? So again, what does that signal? That signals an investor who is his biggest concern is that he might buy it and be down tomorrow. He much more prefer to pay up if people can kind of promise him that it's going to continue to go up in the short to medium term. So basically, if you think about it, he's asking a pro to like, please tell me when I can buy this and not suffer a decline in price in after I buy. No, that's what's the main concern. Obviously, nothing about okay. I think this is should be worth or be trading at 16 cents or whatever. I think that's the fair value. And then it's just a matter of degrees how cheap and how big your returns will be when sentiment inevitably turns around. No, nothing like that. So basically, if you're waiting for that, prices are around 5.5 cents right now. So you hold off buying because you think it might go like this before it goes sentiment turns and it goes up instead. So let's say you hold off buying these juniors and you wait for, quote, the coast is clear, which you never know when it is actually clear, because there's plenty of times when, let's say, it broke out of this, let's say this is a downtrend and resistance. It broke up and you bought here and that wasn't actually the bottom, so it goes down to here again. Meanwhile, you could have just bought it the lower it went, so when it goes back down there, you didn't even lose anything on paper even. But still, I mean, when you think about it, okay, let's say you're holding off here, you're waiting for this to break or whatever, and you're lucky that that break actually, was the low for the next 2 years, let's say. And we say that intrinsic value is up here, so this is like given what we know now, this will inevitably trade to that level. We're just, I mean, if sentiment gets really good, it's obviously going to surpass intrinsic value. Like now, it's been undershooting intrinsic value. But let's just pretend that this is the inevitable target value of this stock. So if you hold off buying here, for example, where you would have a return of 204%, sometime in the future, and you bought when the coast is clear. So you didn't buy when it was most undervalued. You bought when you think when it is less undervalued, higher in price, value unchanged, but you think that you will not have to suffer a short-term price decline. So you're basically, when you think about it, what majority of people do is that they trade good, even better returns they trade away even better returns in exchange for promise that they will not need to see declining share price action. So basically, you're trading away gains for less pain. That's what people typically do. And that's why people hold off on buying now, because they can't stand more pain. So they will wait and wait until returns go lower and lower. When the smart money is, let's say, bottom fishers have already bought in and the sentiment has changed, etc. So they will exchange it. They will get in here and get, let's say they buy here, get 140% return. Meanwhile, the ones who are okay with taking an enormous amount of, quote, pain, because they know this is inevitable, they know the sentiment is going to change, they would already be, they would have over 60% higher returns from this, from buying down here. So they were okay with sitting on this shitty sector, these shitty juniors, quote, I mean, but as they were this cheap and got even cheaper, they just bought more. So they sucked it up. They understand that, hey, this is a lot cheaper or quite a bit cheaper than this level. So why on earth would I want to wait until it got the risk return was lower, and then I buy in? Because if you think about it again, if someone buys here and rides it all this time, he's gonna pat himself on the back like, yep, I never. Let's say you were a perfect trader and it actually just went straight up here. You're gonna be, hey, look at my. I mean, I don't buy anything that doesn't go down. Relative to a person that, let's say, started buying here, bought all the way down here, bought all the way down here, and let's say this continues on and he just buys and buys and buys. He's gonna even though this is gonna look a lot better because this guy got in, it just went straight up. This person is gonna make a lot more money when it inevitably turns in this story, in this case, in this example. And if you think about, okay, this might not look too much. It's like, yeah, you get 140% return, but it's like 200%. You would be extremely happy with both, obviously, even if it took 2-3 years. You should be at least. But if you think about it, it's like 60% added return. If that takes 3 years, if this doesn't change for if this continues this level for 3 years and then it goes up, and the one buying when it broke out, for example, he gets 60% less than you. That 60% extra over 3 years, that's a added compounded annual growth rate of 18%, which is more than double than what the market averages over the long term. Double is the market average if it took 3 years for this to happen. This is what I mean when I say there is nothing more costly than selling low. That is absolutely the costliest mistake you can ever do, because the future expected returns go absolutely exponential. Absolutely exponential. If this just, again, in this scenario, we say that this is an inevitable price point in this case. If this continues for let's say this continues to suck for another year and it goes down to, well, even below, let's say it goes down to 4 cents. That's wait 1 second. Yeah, that's 300% in that case. So you added from this level 200, you get 100% more, 100% better return. How long should you be able to wait for an added 100% return? For 60, if you waited 3 years to get an additional 60%, that beat the market average by twice. If we jack that up to 100%, that obviously means you would should be able to wait over 4 years for that to happen. I mean, all this makes total sense, obviously, and we know that sentiment always changes. But you can just imagine how few on earth would be able to do that, and we would be content doing that. Because now gold and silver juniors investors and speculators are ridiculed because of the poor performance, and that it hasn't turned yet. Yeah, we'll see who makes the most amount of money. You in your hot sector, or a person like me who will relentlessly average down into these extremes. Because when this turns, I'm going to be 100% invested from the literal bottom tick, like I have been all the way since this period. So I'm going to make, even though, let's say like now, okay, losing money for 2 years in the overall portfolio. I think so, at least. I'm not 100% sure. I don't keep track on it that well. Even if this continues for another year and it goes even lower, The amount of money that I will make when it goes higher, I think I will beat everyone that was not in this sector and refuse to buy low here and were in, I don't know, lithium, uranium, whatever. Because when this turns, I think it's going to be one of the biggest bull runs ever, simply given the state of the economy and global financial system. And like we know, Felix Zulauf, for example, he predicts that this will 2024 will be a major bottom in gold, and that it will trade sideways from here until there, or bounce between some 1700 to 2000. I don't know if that's going to happen. I have no idea. But if a bottom, if it takes up to 1.5 years for the next bottom, one should be prepared to just sit in this sector, and it's not going to be a mistake anyway, because even if it goes down here, the average, the ones that are around, I think they will average 1000% easy from this level. So unless you're not down, I think that's going to be a minimum, because he expects it to ramp to 2028. So I mean, who knows? I mean, we saw what happened in 2011 from these bottoms, so it's probably going to be way higher than that up to 2028. So I think you could be down 80% in your entire portfolio if we get another low in the next 1.5 years, and you're still going to be up if you hold this until the next sentiment high. Even a medium term high, let's say. If we go into a big bull, that's going to pay off. You could probably be down 90% like here, and it would still be worth it. But how many are actually able to buy right now and not sell out? And how many do you think would be able to buy and not sell if this continues for 1.5 years more? I think the list of those people is infinitely small. And I think the infinitely small numbers who are able to do that, they're gonna blow 99% of people's returns away. Even though they, let's say, have starting off at a big deficit. Because when that turns, and they have actually jacked up their exposure to at an even extremely cheap level, their portfolios are gonna be so supercharged that they're gonna, even if they're, let's say, behind for 5 years from this top, when that turns, they're gonna blow all of the other ones away. Because let's say somebody has outperformed them in the short term, but they buy back when it looks like this sector is hot again. Let's say that's around here. Maybe they get 216% from that level. Meanwhile, the one who was actually sucking it up, buying as sentiment got worse and worse, picking up micro cap companies or whatever, it's like trading close to or below enterprise value or cash levels, their returns would be maybe 10 times higher. And again, even though, let's say, you're down 80% from the start here, if you just bought, maybe you jacked up in the next 1.5 years, if you added 10% to your portfolio and had an average of, let's say, this level, so let's say the mean price between here and there, all those buys are gonna have like 10 bagger expected future returns. So you're gonna 10 bag that new capital, and the buys that were down here obviously would have even higher returns. So the only way I think to lose from here on out is if this sector goes away forever, which has never happened. Or that sentiment never changes, which has never happened. And that the dollar goes up forever, which has never happened. So you're banking on something that has never happened in history. If in that case, yes, you would be overpaying right now. Even though obviously the merits of gold and silver are like going up every day. And we see commodity shortages. We're seeing COMEX being drained on a daily basis almost nowadays. So I cannot come up with a bigger layup. But of course, that by definition means that 90% of people, more than 90, will not see it that way. They will think you are crazy. They will think you are stupid for hanging out in a sector that, quote, does not work. They sell because they fear the near-term future. They don't see this. They don't see the inevitable rise that always happen. And on that note, it's like, look at lithium, one of the hottest sectors right now. Price of lithium is up several 100% over the last 2 years or so, I think. Okay, yeah, so I gotta admit, it's very tempting to go into lithium right now, because you see all the lithium miners, they're up several 100% over the last 2 years. Some are close to 10 baggers, even more than that, obviously. In this case, for example, this is Pilbara Minerals. I remember this was hot around this period. But then lithium price retraced, and now lithium price is at an all-time high. So this stuff is where people want to be. You see new companies, lithium companies being assembled. You see acquisitions of lithium projects. Everybody's talking about lithium. Do you think we're that early in lithium? But this is what people want to buy. It has worked. Prices are at an all-time highs. And sure, I mean, if you find companies that are cheap relative to where lithium price is right now, I can't say that that's a bad buy. All I know is that I think lithium price is closer to some kind of top than a bottom, because almost every project makes sense today. So I think there's going to be a bunch of projects that are going to get built. And before that happens, I think price will have peaked already, because obviously the market is front running the fact that there's like a ton of mines coming online. But with that said, the expected lithium demand is expected to go up, multiples. And we have the ESG problems with getting mines into permit. So who knows? Maybe lithium actually triples from these price levels. I don't know. I just know that the sentiment is very hot. The price of lithium has already gone up several hundreds of percent. And that's going to bring in a lot of investing in this space. Every mine is going to try to ramp up production. Every deposit is going to try to get built. And what happens if, there's talk about sodium replacing lithium in some of the lower end batteries, etc. And sodium is way cheaper than lithium, because that's like table salt. So there's going to be substitution, I'm sure of that, because these prices are quite wild. But more importantly, look at the amount of retracements this had, because I don't remember exactly when lithium topped, but again, everything works in cycles. So lithium topped maybe around 2008, went down for 2 years or more, then it went back up. So if you bought, again, if you're one of those, I only want to be in a sector that's hot and that, quote, works. Yeah, okay, let's say you bought in here or something. And that's if you paid close attention and actually, bought this breakout. Let's say you bought here. First of all, you would have to suffer because the first breakout was false. So let's say you took minus 42% retracement after you bought in because the coast was clear. So are you going to sit through that if you're a momentum trader? I'm not sure about that. Maybe you sold here because, okay, this looks like a false breakout in that case. You bought in here, sold minus 41%. Great. You took a permanent loss of 41% in, I don't know, a month. Great. But let's say you held on and you or bought back here or whatever. It's like, yeah, you would get a 254% return. Great. Absolutely stellar returns in less than 2 years. Absolutely. But the idiots who were buying this when it got cheaper and cheaper and cheaper, suffered through more than 2 years. Any price paid here would in over 2 years would be lower than this guy's starting price. So if you were crazy enough to buy this as it got cheaper and cheaper and cheaper, and your average price just kept on decreasing, and your share count just kept on increasing, you would have a lot of shares down here. And let's say again, I mean, this period alone, how long is that? 2019, 2000. So hell, that's like, well, okay, let's say, yeah, a year of basing, let's say. So yeah, when you got here, maybe your average would be down here. That would be when, and you just held on to it because you knew that sentiment is going to change, lithium is going to come back in favor. You would have 1,338%, 1,338% return after sitting, well, I guess, I mean, depending on when you actually bought, but in like 4 years. 254% return is great in 2 years. 1,338 return in 4 years is absolutely bonkers and blows this away. So think about it. It's like, who on earth would buy down here? Because you had to sit through over 2 years and a 90% decline. I mean, look at Bear Creek. It's like, what was this? 78, almost 80% decline. And now we're down to almost 90% decline. Nobody's buying these juniors down here. Nobody was buying the Pilbara minerals down here. Nobody was buying lithium down here. The ones who did made a fortune. So what if that took 2 years to materialize? Would you complain in hindsight that, okay, if you knew, this is going to change and I got a 10-bagger, more than a 10-bagger, by sitting on my hands in 2 years? If you get this kind of return, this is like, what do you think is going to happen with the average junior from these levels in the next 4 years? I expect to see this kind of action. And this is potash, another example. Potash is apparently quite hot as well. It's been going up. A lot of metals have, obviously. But look at these kind of... This is a log chart, actually, because... maybe this drives home the point even more, perhaps. Over a 2-year decline from this top, down 93, and then it went up, I don't know. 1,100% in about 1 year. Okay, yeah, would you be happy with that? I mean, if your average was like this, that's 282%. If the more you bought, obviously, the lower it went. When it was down 93%, your buys would have averaged some. Yeah. I mean, look at how exponential the returns are. It becomes absolutely silly. As we go into it. When something is extremely cheap and it becomes extremely cheap, minus 20%, that is enormous exponential ramifications for your future returns. Here we had another top that was over, I guess, over 2 years, close to 3 years actually. So 3 years of downtrending action, minus 90% again. And what happened after that? When the bottom was in, from bottom to peak in this potash company, 5,742% return. In 2 years. 2 years. Do you know how long you should be willing to wait for a return like that? I don't know. 30 years? 2 years. And even now, with a fat retracement from the top, that's still... So it went down 52%, and you would still be up 2,641%. What I'm trying to show is that these sectors go out of favor, and that why they're so out of favor, that means that the next rally will be even higher, typically, especially if you have the future in I mean, we have a much bigger supply shortage problem now, and in the future then we had after, because this was when miners had actually been ramping up production. Now we have underspent in capex, and that goes for gold, silver, and copper, and all of that. So the fundamentals for the metals themselves are even better today than they were after, it peaked here. So just imagine how, again, I mean, this is, again, it's like global financial low to next peak. That's in Great Bear, 3,800%. And we have seen that in Pilbara Minerals, lithium. I mean, from bottom here, it was like 3,400%. And in potash, in this case, 5,700%. After both were down 90%. Bear Creek and Junior, or Bear Creek at least, we're closing in on, some being down 80-90%. There's no shortage of examples. When a sector gets that out of favor, the future returns go absolutely ballistic. So stop fearing what it might happen today, today or tomorrow, or that it might go down to from minus 90% to minus 87% to minus, hell do I know, 93%. Because when these flushed out sectors turn, which they will, 100% sure they will, the returns from these extremes will be absolutely mind-numbing. So anybody who sold down here, this person who sold this bottom tick when it was down 90%, gave away a future return of 5,700% if he, a theoretical, because we don't know when he would have sold. I mean, 5,000. If you have 5% of your portfolio left at these bottoms, you would make it back within 2 years and more. That is how crazy this is. So in theory, if you look at like a lithium stock like this or a potash stock like this, you could be down 90% in your whole portfolio, even more, 95, and you would have still made it back and made money in the next 2-3 years. So let's pretend that you actually bought some at these low as well. So you were only down, you averaged down, so you were not down 90%. You averaged down, so let's say you had, comparably speaking, 80% minus. You would still make a super high return if your average was here. That would be good enough. That's a 25 bagger in this case. You would make money if you were down 95%. You would make a lot of money if you were down 80%. I hope this helps. Again, it's like there is no way in hell I am selling juniors down here. Absolutely no way in hell. And what keeps me in the game is knowing how markets work, seeing how markets work. And I cannot afford to sell these lows because I'm waiting for the dollar to top or waiting for the coast to be clear. When the coast is clear, you can forget about these returns you get during these depressions. You can forget about returns from these levels. When the coast is clear, we might be up here. When was the coast clear in this potash company? Yeah, okay, maybe up here. So you get 475%. Superb results, absolutely. But you could have gotten around 2,300% just by keep on buying low, even if that low got lower and that low continued for trading sideways for 2 years. First a decline of 2 years, then let's say nothing much happened for a total stretch of like 4 years. You would still beat the absolute brakes of the ones who got in later when the quote coast was clear. Same Pilbara Minerals. You bought when the coast was clear and people were making money, and it felt good because you think, yeah, I think this is gonna go higher now because the trend is up. Sure, the trend was up and it went higher, and you might have gotten your almost 200%, and you would be like, yeah, heck yeah. I mean, I'm glad. And in the meantime, you had this totally unemotional investor who just kept on buying. His portfolio just kept being destroyed, but he averaged down for years. And when you're celebrating your perfect trading, etc., this guy would have blown the brakes off your portfolio by a wide margin. So when you're sitting and celebrating your 200%, this absolute value maniac here, he would be up 1,257%, and his lowest buys would be up like 3,000%. Yeah, long rant as usual. I do these videos not only for like other people, but to remind myself. And I mean, if you can maybe create a playlist or something on YouTube with called Copium or something, Hopium, and just remind yourselves of how markets actually work and what actually makes sense. And that 95% of comments on Twitter or forums, etc., are absolute garbage. Never forget that most people don't make any money. But everybody shares their opinion of how they think they are gonna make money, or how people should make money. Most people, some of the most, let's say, prevalent posters on Twitter or whatever, I'm pretty sure they don't really make much money, but they have a lot of opinions. And I mean, a lot of people have smart things to say about macro. But I don't think that's the most important thing. I mean, people have been calling for a ramping dollar forever. And I don't know how you really played that. How did you really make big money? Because timing, typically, if you're playing options, etc., that's going to play a big part. Maybe some made, were lucky and bought dollar calls here or whatever. But it's like, if you just understand how markets work and the cyclicality of markets, and that if a sector goes down 90%, the rally afterwards is going to be huge. That's enough, really. You don't even need timing, because obviously when you see what happens for a sector that's gone down 90%, do you need timing? Who cares if this took 4 years or 5 years or even 10 years? In these examples, it took 2 to 3 years. But it could take way more than that, and it would still be worth it. Don't buy, absolute crap, obviously. But, I mean, buy the best juniors you can find at these extreme prices. And be content knowing that they might very well fall 30% more. And that doesn't change the fact that they're going to go up one day. Going to go up a lot one day. And the lower they go, the more they're going to go up from that. So if you liked it, if you like the stock at minus 80%, nothing really bad has changed. It goes down, X amount of percent more. So that's down 90%. All else equal, that if you just keep buying that, the returns are going to be absolutely extreme. You can see here, just, from, let's say you bought it at 15 cents something. It went down to, let's say, just 12 cents. Look at the change in expected returns. It's incredible. It's incredible the kind of torque you get at these extremes. And if you, again, just, pointing out the obvious, it's like selling low is the most costliest thing anyone can do. That's why I keep saying I can afford buying tops, because I always buy the bottoms. Always. I cannot afford to sell bottoms. In that case, I need to be good at timing. But if you just buy extremes and the lower they go, you should be thinking about shorts like this. shorts like this, every time you see something go down like that, because this feels like absolute death. This looks even worse than the juniors. So imagine the kind of pain you would have to sit through. And by God, would you have been happy that you actually bought? I don't know if, I mean, depending on how much you have. I mean, I think when the sector turns, when the junior sector turns, especially if it goes even lower and you're able to buy more, I think, I mean, again, depending on how much you have, I mean, people could probably, I mean, if someone bought the lows in the global financial crisis with a meaningful amount, they could probably retire when it reached the peak. That's 20 times your money. So it's like 10,000 invested, you have 210,000. Yeah, just think about it. Okay, rant over. Thanks for listening. Buy a quote. This is not investing advice. Do your own due diligence and make up your own mind. Just make sure that you understand what you are doing. I will not, for example, be able to hold your hand every day until this sector turns. Just keep reminding yourself of these concepts. Try to buy the best juniors, your favorite juniors. You can, obviously. And just remember to have a longer time horizon than the market always, because nobody has a long time horizon. Thank you for listening. Hit the thumbs up if you like this stuff. Bye.